So if you've ever wanted to receive dividends from a gentleman's club, a professional football team, a world wrestling organization, and a horse racing institution, hey, what's up? I'm Russ. This is the right video for you. Welcome back, and if you haven't been back before, you better hit that subscribe button or else. So we're going to talk about a few companies here that you probably didn't know paid a dividend, and if you did, I don't care, just play along like you didn't, and we're going to go through them really quickly just to put them on your radar, and I'm also going to look at the Simply Safe dividend information, kind of peel through that quick. We're going to get an intrinsic value to see if any of them are at a good spot to buy right now. We're going to see which of these over the past 10 years with a total return, remember, total return being all their income and the share price appreciation. So here comes our first company. It's Rick's. Look it, you recognize that girl from the thumbnail. I don't know who she is, but it is RCI Hospitality Holdings, ticker RICK. Now, they were founded in 1983 under Rick's Cabaret. They currently have all these wonderful brands. They have over 40 subsidiary brands that they own and operate, such as Rick's, Jaguar Club, Studio 80, which I understand is a dance club. Now, they IPO'd in October of 1995. Anna Nicole Smith met her billionaire husband, who was 89 years old. I remember that weird thing at Rick's Cabaret out there in Texas. And as we saw here, they're expanding their empire. Hey, you may not like it. This is why it's called personal finance. You don't have to invest. You don't have to invest in tobacco companies or booby bars, as my wife calls them. But in October of 27th, they acquired Heartbreakers Adult Nightclub, which you see added to their roster of subsidiary brands right here. And by the way, the link for all of these investor relation pages will be in they'll be in the notes below. So here we are. Here comes the Simply Safe dividends, Rick's, ticker RICK, RCI Hospitality Holdings. It's just hard not to say Rick because that's the ticker symbol is Rick. They're unrated, a teeny tiny itty bitty small yield of 0.22%. Probably not a lot of small things in their clubs around there. A lot of high spenders, I would assume. Did have a nice dividend growth, though, of 14% was their last growth. Small cap company, only $815 million. But we do see that they really weren't paying a dividend. They started, it looks to me, paying that dividend in 2015. They're currently paying 20 cents per share per year, which divided by 4 is 5 cents per share per quarter. That's the kind of hard-hitting analysis you get here on the Dapper Dividends YouTube channel. Couple financials don't look too bad. They don't look too bad. 5% free cash flow payout ratio, which they did have that big bugaboo at 230%. That may have been from another acquisition or some one-off expense. But all in all, $3.93 free cash flow per share, 48% recent growth. They had that hiccup in 2020 from COVID when everything was shut down. Shares outstanding, they did dilute just a little bit to 9.32 million. I think they probably used some of that to use the Heartbreakers acquisition. Shout out if you've been to Heartbreakers, if you work at Heartbreakers. Hopefully none of your daughters will. But with that being said, total sales, $251 million. So they got room to grow. I don't know if they're setting up an empire here. Moving on over to Alpha Spread, we'll look at their intrinsic value. Currently about 5% overvalued as of this recording with a base case intrinsic value of $86.78. Remember, the intrinsic value is not an exact number, even though we see an exact number. It's more ballparking. It's more like knowing that somebody needs to lose weight without knowing exactly how much they weigh. And then the worst case, $73, so about 19% overvalued. Interesting, the analyst that decided to give them a price target, even the lowest has about 11% upside. And I found this interesting, that 19% of the company is held by insiders. That's really high and really interesting to see. So it shows that the insiders inside the company, because that's where the insiders are at, are pretty confident in the direction that RCI Hospitality Holdings is going. And we see that in the last 12, 9, 6, and 3 months that the insiders have indeed consistently been buying, which is a good sign. All right, where are all the football fans at? All the world football fans at? We've got Manchester United in the house, ticker MANU. Now, I know they've been in the news here a lot because the Glazers, from what I understand, are thinking about selling the team. Apple's been rumored to potentially be buying them. 144 years of history you can own. You can be an owner of this team, at least until if it gets sold and goes private. But as things stand right now, they are a publicly traded business. They are a company that you can own. Was Manchester United? They're also unrated. Another itty bitty teeny tiny dividend yield, but not as teeny tiny as Rick's, 0.81%. But a bit of a spotty dividend growth. As you can see, they cut it and it looked like they did not pay a dividend for a few years there, but they have increased it. They did a 14% raise as of last year, currently paying 18 cents per share. This is semi-annual, so every July and January they pay that out. Yeah, financials not looking so good. When I did take a peek at their financial statement, the cash flow statement, it looked like they're borrowing money to pay that dividend. It looked like they borrowed about 40 million pounds in order to pay the 33 million pound dividend from what I can see. But that free cash flow payout ratio is currently 821%. So definitely not very good. Only 2 cents of free cash flow per share, so not enough to cover the dividend. And just everything does not look like all is well with good old MANU playing in what, Old Trafford Stadium or something, I think I read. Their shares outstanding, 163 million shares. Sales, 583 million. But negative return on invested capital, return on equity, that is no bueno. 80% net debt to capital, and they don't have enough operating income to cover the interest on the debt, according to Simply Safe Dividends. Now, what about MANU for the alpha spread intrinsic value? $12.38 at the base case, meaning they're about 44% overvalued. And the worst case, just a shade under at $11.46. Lots of negativity all around MANU, and every analyst is just giving big downside on their price targets, with the highest still having 19% downside from here. So that's Manchester United, which looks to be just a little bit overvalued. I'm sure there's a ton of football fans out there, and I would love to know if you own Manchester United or you would even consider buying them right here. Shout out to my buddy Harris, who was on my live stream talking all about WWE, and I am more informed that they may be going places in the future. They're a bit of a company that is going to be in transition, according to my buddy there. So check it out, WWE. I think everybody knows when I was a chill and little baby cheerins, they were called the WWF, World Wrestling Federation, but the World Wildlife Foundation Fund, whatever, had a problem with that. So everybody pretty much probably knows who the WWE is. And if you didn't, they show that they are in 180 countries, 28 languages, 24/7 streaming network, and they have over 1 billion social followers. And if you want to read more on that, this link is in the description below. And we're 3 for 3 here on being unrated. This dividend yield is also tiny. It's about Apple's paying a 0.60% dividend yield, but they are not growing that dividend. As Harris said, they ran into some struggles back in the 2010, 2011-ish area, 13, something like that. So that dividend has been frozen since 2012. Currently at 48 cents per share every quarter, but they're paying it. Next ex-dividend, according to that, when this video is being filmed, is December 14th, which is 14 days away. Maybe you want to get yourself a little Christmas present and get those WWE dividends, which they should be able to keep paying. Their free cash flow payout ratio, 23%. That's really, really low. Currently bringing in $2.07 of free cash to the bottom line, so they can easily pay that. Sales growth, 24%. Dude, that is big up, but they consistently have been diluting shareholders the last few years, currently at 86 million shares. But their total sales, hey, if you're going to dilute shareholders, you better be increasing those sales, which they totally are increasing those total sales, 1.23 billion. Very high return on equity, return on invested capital, 29%. That's pretty dang high if you ask me. not a lot of debt, and I always love the interest coverage ratio because this tells us how much operating income we have to cover every $1 of interest expense, which we have $11.24 of operating income to cover that interest expense on the debt, so there's no problems there. And here comes alpha spread with their intrinsic value, $63.32 base case, so about 20% overvalued. I guess you're paying a premium for the old WWE, and the worst bear case is about 38% overvalued. It's nice to look at the worst case. I know some investors want to go 10% below the worst case intrinsic value, which is about 5 years of negative growth if you build that into your model. Couple nice profitability and solvency scores for WWE, and I thought this was interesting in the ownership circle here, not the squared circle, but in the circle, that insiders own 41%, and actually 45% is what the insiders own, with Vince McMahon owning 10%. It says right here, we can read that. And the only sales that I see on insider trading were Kevin Dunn and Bradley Blum sold some stock, with Kevin Dunn selling 1 million. Who is Kevin Dunn? I didn't even bother to look that up. But either way, it looks to be a little bit overvalued, does WWE right now. And bringing up the corner around number 4 here in the last spot is the old famous fabled Twin Spires Churchill Downs out there in Kentucky. 148 runnings of the Kentucky Derby. Yes, you can own Churchill Downs if you love to gamble, if you love horse racing, you love the Kentucky Derby. Why not own the Kentucky Derby? Which, yeah, this is a really old company, but they IPO'd in March of 1993. But you don't just get the #1 most profitable horse race wagering platform. You also get 26 industry-leading regional casinos, which I did write down. That is in 8 states. And as we see here, and I'm going to read to you, the Kentucky Derby is just the beginning, yada, yada, yada. Something about Churchill Downs Incorporated. You can read all about it on your own free time. And then they wrap it up with an unbeatable view. Have you ever been to the Kentucky Derby? And hey, look at this. We didn't get a 4 for 4. We've got a very safe dividend safety score of 90, but that dividend yield is only 0.32%, so it's a little bitty, teeny tiny dividend yield, but they did grow at 7% in October of 2022. Mid-cap stock, $8.13 billion market cap. They have 27 years of uninterrupted dividends, but they have been increasing it for 11 straight years, so that means they even increased it through the COVID pandemic. And unfortunately, at the recording of this video, the ex-dividend is 23 hours away, so you won't be able to get in. They do pay that dividend annually, which, if I had foresight, I probably would have done this, but you're going to have to wait till next year. 71 cents per share, and they have been obviously increasing that. Now is not that great of a time, though, because their dividend yield is currently 22% below their 5-year average, and they're at the higher end of the 52-week price range. But they're going to be able to keep increasing that for quite some time. Dude, 16% free cash flow payout ratio, that's really, really low. $4.10 free cash flow per share, easily going to be able to cover that dividend. Sales growth dropped to 12% though the last 12 months, but they keep buying back shares. Only 38 million shares outstanding, so that's interesting to see. And their total sales, they have generally been going up and to the right, currently at $1.69 billion the last 12 months. That return on equity at 101% looks a little suspicious to me. We'd have to dig into that. But I'm not really planning on investing in Churchill Downs, so I guess that would be for you to do, huh? Let me know. Get back to all of us. Free cash flow margin, though, is negative 77%. Net debt to capital has been going up, so net debt at 84%. That is getting a little bit high. That interest coverage ratio, no good at 3.21%. So that's Churchill Downs. Let's see what their intrinsic value is. Oh, here we are on Alpha Spread. It's $283.01. So according to Alpha Spread, they're about 22% undervalued. And let's go to the worst case. That's overvalued. I knew one of them was going to be over. Currently 8% $203.70. And check out their ownership. Here we go. Insiders, 5.46%, not too bad. Institutions are at 64.72%, quite high. But a lot of retail investors, maybe there's a lot of gambling addicts that love to also gamble on the stock price of Churchill Downs. And their insiders bought $92,000 thanks to Alex Rankin. Or is it our Alex Rankin? I don't know. And here's the total return that I promised you for all four. The big winner. Check it out. WWE, 1,123% over the last 10 years. Remember, that's the share price, and basically all income attributed to the stock is the winner. But the second one, check it out, Rick's is 1,084%, Churchill Downs 1,025%, and then the laggard all the way that's been pretty much flat at the bottom until that nice little pop as of the recent news was Manchester United. So those had some nice returns, and one return I really missed out on was in this video right here where I talked about Starbucks, why I probably should have done something completely different and something any of you could do. So if you want to find out what that is, click the little box here next to my head and I will talk to you there.